please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
A guest who is watching Indian skies very closely from the United States, Arvind Sanger, managing partner of Geosphere Capital Management, joins us now. Good morning, Arvind. Thank you very much for joining us. Suddenly in the last few weeks, the emerging market scene has gotten very, very cloudy. While Brazil, Argentina, the Turkish political scenario, all of them have been developing. Suddenly, China is becoming even much more of a problem. The yuan has fallen by 3% in the last few days. Is this likely to balloon into something nasty?
We don't know because we are seeing, much more sustained pressure from the U.S. In terms of trade war threat, tariffs threat, as well as technology kind of, exports threat. So I think that China is under the gun, and there is some question whether China is letting the yuan fall to offset the tariffs, or the yuan is falling on its own. But China is seeing a slowdown, and you had the Chinese central bank, loosen some of the reserve requirements, and that again creates somewhat looser monetary policy, and that also causes a downward pressure on the currency. So I think that there are many factors, and it's not clear which factor is dominating, but clearly it creates a lot of stress for other emerging markets. When the largest emerging market in the world and the second largest economy in the world is seeing this kind of pressure and is seeing this kind of currency weakness.
Okay, Arvind, good morning. What about India? Last year the best asset class in the world was perhaps Indian small cap. Right now it's the most hated one. Your thoughts on what's happening to the broader universe? Is this just a case of excesses being washed out, or is there something more sinister?
Well, and I've said this before on your show a few weeks ago, I think oil is headed to $85 to $90. I may have said, going higher from 80, but I feel very strongly that as we see the Iranian sanctions bite in the next few months, and we get surprised by the fact that lack of infrastructure in the U.S. causes oil exports or oil production growth in the U.S. to severely fall short of expectations. If both those happen, which we expect to happen, then oil is going much higher to kill demand. And that's the problem for India and China and other emerging markets. What kind of oil prices is it going to cause oil demand to slow down? And frankly, the way oil demand slows down is the economy sees some pressure. So I think what you have is an economy in India that is finally clicking. At a time when the macro headwinds are just starting to gear up. So looking at all the recent data in India is frankly not very useful. What we have to look at is what will the data look like if global demand growth has to slow down for oil and Indian demand growth has to slow down? What is the economic implications for the rest of the economy? And I think that's kind of the risk that, whether it is inflation or it is the central bank interest rate policy of RBI, or it is any other metric, I think there are headwinds ahead, and that creates, frankly, a flight to liquidity and a flight to large caps, which is understandable, and clearly, where we were seeing a financialization of assets as a theme that was playing out in India over the last few years, we're now seeing a reversal of that theme as people get nervous and look to get out of financial assets. So I think, I don't think the Indian stock market cycle on a long-term basis is over, but I think it is under severe stress this year, and we've already got into correction territory for the small caps. I don't think the overall market is bulletproof, and the large caps are bulletproof if oil prices continue to climb as I expect they might.
Okay, Arvind, hi, good morning. If you go by the old adage, you should be greedy when the market is fearful, right? I mean, is that the way to approach this market now? Deploy some cash into large caps, or do you think it's better to just stay away for a bit?
I think that deploying cash into large caps vis-a-vis small caps may be a good idea, but if large caps have not fallen and the assumption that they're bulletproof in a sell-off, then I think that's a risky bet. My sense is the market is headed lower, including the large caps. Yes, but I think it is under severe stress this year, and we've already got into correction territory for the small caps. I don't think the overall market is bulletproof, and the large caps are bulletproof if oil prices continue to climb as I expect they might.
Okay, Arvind, hi, good morning. If you go by the old adage, you should be greedy when the market is fearful, right? I mean, is that the way to approach this market now? Deploy some cash into large caps, or do you think it's better to just stay away for a bit?
I think that deploying cash into large caps vis-a-vis small caps may be a good idea, but if large caps have not fallen and the assumption that they're bulletproof in a sell-off, then I think that's a risky bet. My sense is the market is headed lower, including the large caps. Yes, you step into a market when there's fear, but I'm not sure that the fear is widespread enough, or the stocks look sold out enough, or washed out enough that we can say that the fear is widely prevalent and therefore it's time to step in. I do think that we have to be patient and be greedy. And what I mean by greedy is, whereas in the past I would have said that if we get a pullback to a reasonable level, you don't want to be too cute and miss it. Now I think we can afford to be greedy and wait for things to get really attractive before stepping up, because I don't think there is any rush of money coming into this market, either from global investors or certainly from domestic investors. Last year, domestic investors were driving the market. This year, at least, looks like domestic investors are licking their chops and are also looking to take money off the table. So I don't think we're at levels of pain yet where the market looks, compellingly cheap.
Arvind, from what you have told both Anuj and Sonia to their questions, is that there could be a perfect storm building in terms of higher crude prices and a Chinese triggered currency question mark. I mean, the rupee is within handshaking distance of an all-time low. 69 looks round the corner, maybe today, according to some of the experts. But the difference between now and 2013 is that clearly there is growth now, as you pointed out. So do you think, again, to extend Sonia's question, this should be the time to buy? Because the storm is coming at a time when other fundamentals are at least clicking, especially growth. And if that is so, where are you buying? I mean, are you going to buy the IT stocks? Are you going to buy pharma stocks? Would you be buying consumption stocks? Where would you train your eyes?
Well, I mean, you were talking a little earlier about somebody like a Motherson Sumi. And let me first say one thing. 2013 you're comparing to, well, the index, Indian equity index is signigily higher. So let's separate the rupee from the index, right? The rupee, given where the rest of the currencies have gone, given the inflation differential versus the US, has done quite well. So a moderate depreciation from here really shouldn't mean much, because over time the rupee is not going to, not test that 69 and exceed that 69 level. So I think getting overexcited about the fact that rupee may go to 70, I don't think in the overall global context that's that big a deal to 5 years later get back to those levels after having been stable for a few years. But if we talk about the index is significantly higher than what it was in 2013. So yes, earnings are better, but the index is better. And I think the real challenge here is that the global headwinds, there was just a taper tantrum fear, but the global headwinds today are somewhat more broad-based, and it is not about the taper anymore or about the Fed raising it. It's about trade war. It's about pressure on China and Chinese currency weakness, and it is about oil prices going up sharply now. In 2013, oil prices were $90 to $100, so you can say they're lower than that, but they've gone up sharply in the last few months, and they could continue to rise. So I think there are a different set of circumstances why today the market could see some correction. But you're right. I mean, we're not seeing this as an end of the cycle, and we are going to be greedy to buy. We're just going to be a little bit patient, because we don't think there's enough, fear yet. Yes, mid caps have corrected, mid and small caps have corrected 30%, but we think, unless we get some sell-off in the large caps and a broad-based sell-off, we don't think there is broad enough pain yet to say, it's all hunky-dory and let's get back into large cap because that's a safe place to be. Okay,
so apart from crude oil, Arvind, what could be the catalyst of that large cap fall? There's one, school of thought which believes that the FANG stocks perhaps are in a bubble territory and that could be the next catalyst for a big global breakdown. Would you agree with that view?
I'm sorry, which type of stocks?
The FANG stocks in the US.
Okay, yeah, I think I agree. I agree that the FANG stocks, the technology kind of bellwethers that have held up this market, they are amongst the most global companies that are amongst the best beneficiaries of selling around the globe. And if global tensions continue to rise, and if global, tensions in terms of trade and in terms of restriction on sales by U.S. of technology to China, if all of that continues to happen, then I think that clearly if that bastion falls, the NASDAQ has been a significant outperformer versus the S&P year to date. And if that starts to give way, which I think is likely if this market continues to correct, that is not going to remain an isolated island, then I think that does create a broader risk for global, large caps also.
So if we are looking for, stocks or companies to buy in this market, maybe not now, in the due course of the next couple of months, you briefly mentioned names like Motherson Sumi. Is this the time to be looking at these names? Not just Motherson Sumi, Ashok Leyland has fallen so much, a whole host of others, Torrent Power. Good quality companies have been falling quite a bit. Do you look at this space now?
Absolutely, absolutely. Those would be the type of companies that we would be most interested in, because our view is that, this is not a time to buy low-quality stocks with the questionable management. You're going to get an opportunity to buy high-quality stocks with solid managements and solid long-term growth outlook, which are having some headwinds. I mean, let's take Motherson Sumi as an example. There is talk about U.S. threatening to put tariffs on European car imports. That would be a big deal for car sales of European companies, which would be a big deal for Motherson Sumi's growth outlook. So those are real business risks which could cause some earnings risk near term. But to the extent that these trade tensions are going to play out relatively soon, and we'll know what the impact is, and at that point we can make a clear-eyed assessment of how much, if any, impact will be there on the real demand. Then a company like that with an excellent track record of returns and of acquisitions and of growth is one that we would definitely be interested in. Okay. Similarly, you mentioned Ashok Leyland. I think they've done a phenomenal job in the domestic market, and they have some long-term growth opportunities in exports and in defense sales. So I think this is a company with a lot of things going for it, and that would be another name. So I think that that's exactly it. On the other hand, let's take companies like HDFC Bank or some of the others that have not sold off at all. It's hard to say that those are the ones one should one should add money to, because those stocks have not had any impact of the sell-off. But the other ones you mentioned, the high-quality names which have sold off, that's where we are most interested right now.
Okay, can you just expand that list? I mean, rather than me put words in your mouth, where would you want prices to fall and gravitate towards them, and where would you buy anyways straight away?
So, I mean, another name I would mention would be somebody like an L&T, right? That's a domestic, I think CapEx cycle is just starting. Infrastructure spending is going on. Housing might be recovering. That could be an interesting name. Another area we are very interested in is real estate. This is a sector that has done nothing for the last 5 or 6 years. You have, seeming to be that the cycle is starting to turn. If people are looking at inflation and getting a little bit more interested in hard assets in an inflationary environment, and where financial assets are becoming a little bit less exciting, then real estate is a sector where there's a lot of pent-up demand because of multi-year lack of demand growth. And we think, some of these companies, DLF is in the market doing an equity offering, getting essentially debt-free. That's a large cap name. There are other names which are high quality that, have done a little better. So it's harder to get excited about them unless they sell off. But that's a sector we're quite interested in. So, there are select areas that we think there are opportunities if stocks sell off. As to when exactly we would buy, it's it's hard to say, but we are keeping an eye on valuations, and we are keeping an eye on market sentiment. And our sense is market sentiment has clearly moved from greed to moderate fear, but it has not gone to panic yet. And I think that somewhere between moderate fear and great fear and panic is when we think the buying opportunities are going to come into play.
Last question from my side, Arvind. What about a set of 6 or 7 stocks this year which have made huge money and continue to see money chasing some of these stocks? Britannia, Page Industries, Hindustan Unilever, the Bajaj Finance, Avenue Supermarts of the world. What about some of these names?
Well, I think that these are domestic demand stories. And domestic demand stories have some of the most nosebleed type of multiples. We frankly don't disagree that the domestic demand story may have somewhat more secure fundamentals, but we just have a hard time with valuations. So at the end of the day, these stocks are at the higher end of historical valuations. We'd like to see valuations come down. So the sectors are good. Some of the multiples are not so exciting.
All right. Arvind, we're loath to say goodbye to you, but I think it's time you have to retire for the day. So thank you very much for joining us.